The stock market should have already crashed. Every major indicator is flashing red. Consumers are drowning in debt. The economy feels unstable, stretched, fragile, and yet the market keeps rising. Why is the financial system still holding together when all the historical warning signs point toward collapse? I am a financial historian. I look at markets not with optimism, but with skepticism shaped by history. And history teaches a simple lesson. Markets don't break when everyone expects them to. They break when people stop believing they can. What we are witnessing right now is not strength. It is delay. A delay that has created one of the most dangerous market paradoxes of our time. Because valuations today are not just elevated. They are higher than the peak of the dot-com bubble. And the real reason the crash has not happened yet has nothing to do with innovation or economic health. It has to do with three hidden forces quietly propping up the system, forces Wall Street prefers you never fully understand. This is not a forecast of disaster. This is pattern recognition. Let's start with the warning history never ignores. One metric has consistently warned investors before every major collapse. It removes emotion and narrative and focuses on scale. It compares the total value of the stock market to the size of the real economy that is supposed to support it. Today, the total market capitalization of U.S. public companies is roughly $66 trillion. U.S. GDP sits near $30 trillion. That places the ratio at approximately 220%. Historically, anything above 100% signals a fundamentally overvalued market. Before the dot-com crash, this ratio peaked near 115%, and the market collapsed by more than 60% shortly afterward. Today's level is not just high, it is unprecedented. There is no modern historical example where markets sustained this level without severe consequences. This is not optimism. It is a mathematical detachment from reality. The same distortion appears in earnings valuations. The S&P 500 has historically traded at a price-to-earnings ratio near 15 or 16. Today it runs closer to 25 to 28. But the real danger is not the average. It is the concentration. A small number of companies now carry extreme expectations and outsized influence over the entire market. Investors are paying $30, $40, and sometimes $50 for each dollar of earnings, in some cases even more. This is not rational confidence. It is belief that growth will remain flawless indefinitely. And belief in financial systems is always fragile. The first hidden force holding the market together is the weakening of money itself. Chronic deficit spending combined with continuous monetary expansion does not create real wealth. It dilutes currency. Asset prices rise not because productivity improves, but because the measuring unit loses value. When more money chases the same assets, prices rise mechanically. This creates the illusion of prosperity. This process is described by the Cantillon effect, a principle that explains how newly created money enters the system unevenly. It flows first to governments, financial institutions, and asset owners before it reaches wages or savings. Those closest to the source benefit the most. The result is a quiet and ongoing transfer of wealth. The top 10% of households own nearly 90% of all stocks. As asset prices rise, this group benefits disproportionately. Everyone else pays through inflation, higher living costs, and eroding purchasing power. The market looks strong on paper. Indices reach new highs. But beneath the surface, holding cash becomes a guaranteed loss. Prudence is punished, leverage is rewarded, and speculation becomes a necessity rather than a choice. This is not a temporary distortion. It is now a structural feature of the system. Structural concentration and passive risk. The second hidden force is the extreme concentration underlying today's market resilience. A narrow group of AI-driven and high-technology companies now dominate index performance. Their revenues, margins, and future projections carry disproportionate weight. Their valuations assume near-perfect execution and sustained dominance far into the future. This introduces duration risk on a scale rarely seen in financial history. Any disappointment, even a minor one, can ripple across the entire market. This risk is amplified by the dominance of passive investing. More than half of the S&P 500 is now owned through passive strategies. Passive funds do not assess valuation or fundamentals. They follow rules. When markets rise, passive inflows reinforce momentum. When markets fall, passive funds sell mechanically. They sell the largest components first, because that is how indices are constructed. What supports markets during the rise ensures acceleration during the decline. Liquidity disappears precisely where it is needed most. Correlations rise, volatility spikes, and selling feeds on itself. This structure feels stable during calm periods, but it stores instability beneath the surface. It is not resilience. It is compressed risk waiting to be released. The third hidden force is the one most carefully avoided in public discussions. After the 2008 financial crisis, banks were forced to appear safer. This was achieved not by eliminating risk, but by moving it. Regulatory reforms focused on balance sheet optics and capital ratios. As a result, the most dangerous exposures were shifted off regulated bank balance sheets and into the opaque world of non-bank financial institutions. This shadow banking system, worth trillions of dollars, operates with less transparency, weaker oversight, and fewer capital requirements. It holds leveraged loans, private credit, and high-risk debt instruments that depend heavily on continuous liquidity and stable confidence. As interest rates rise and refinancing becomes more expensive, default risks increase. But these risks remain largely hidden from public view. The conventional banking system appears stable precisely because the risk has been relocated, not resolved. This is regulatory arbitrage on a massive scale. It creates the illusion of safety while preserving the conditions for systemic contagion. History offers a consistent warning. People mistake delay for safety. Every major market collapse follows the same psychological sequence. First, markets remain irrationally strong. Prices continue to rise despite deteriorating fundamentals. Then investors grow numb to bad news. Inflation, layoffs, debt warnings, and slowing growth stop moving markets. Finally, a single confidence-breaking event appears. It could be a bankruptcy, a credit failure, or a sudden policy shift. That event does not cause the crash. It reveals it. Crashes do not arrive gradually. They arrive suddenly. Liquidity evaporates. Selling accelerates faster than models predict. And the longer the collapse is delayed, the more violent it becomes. Because leverage has accumulated. Because expectations have stretched too far. Because confidence was mistaken for stability. This system is not held together by productivity, balanced budgets, or sound money. It is not anchored to gold or long-term discipline. It is held together by confidence. Confidence in institutions, confidence in liquidity, confidence that intervention will always arrive in time. And confidence is the most fragile asset of all. Once it breaks, it does not bend, it collapses. History does not announce its lessons loudly. It does not change, it waits.